Well, folks, the stock market has a brand new problem. It rhymes something with crapple, snapple, lapple, rapple, something like that, okay? If you can guess it, you're pretty good at this game. I'm going to talk about that. That's going to be the core subject of today, this new problem the market has, okay? I've got a few other subjects I want to talk about, including some companies that report some earnings, some big movers out there, my expectations around a stock of mine that's reporting earnings tomorrow, and many other various things. Hope you guys enjoy. As always, thank you everybody that subscribed to the channel. I appreciate each and every one of you. Alrighty, guys, so let's get started here. So just wanted to show you kind of where we're at with the indexes as of right now. We're almost 23% down off all-time highs for the S&P 500 at this point in time. We're over 36% down from all-time highs on the NASDAQ now at this point in time. And the Russell's been surprisingly strong. You can't get too excited about the Russell because it's the Russell, okay? And sometimes it shows you some glimmers of hope, and then it gets your hopes up, and then it just crashes it back down. So, but as of right now, that one's starting to outperform the NASDAQ quite significantly. That one's down about 27.9% off all-time highs right now. The Dow has definitely some pain coming in 2023, in my personal opinion, and I discussed that in videos recently. To take a peek here at something very important, look at Google stock down massively again here today, down another 4% for the stock. It's now down 42.4% year to date for Google McDougal. It's I mean, literally you get two more weekdays in the NASDAQ and this baby's at a 50% down. From all-time highs, it's getting close to 50% down now at this point in time. Amazon is down over 50% now from its 52-week high now at this point in time, and it's down 47.6%. On a year-to-date basis, down another 3% here today. This one just can't find a bottom anywhere, and I do have something to share with you that's important in regards to Amazon and Amazon stock a little later in this video. Meta is I mean, it's just ridiculous at this point in time. You just kind of have to laugh at it at this point in time, man. Stock's down almost 74% year-to-date for Meta. Incredible. Tesla is down 46% and is down over 50% from its 52-week high now at this point in time. And Nvidia, another massive tech company, massive tech giant, down 55% year to date. Microsoft, 36% down year to date. Incredible moves, right? Now, what I'm going to show you on this next slide here is going to absolutely blow your mind. It's almost shocking to see this, and this is about to end, okay? Check this out. Look at that one stock there that has so massively outperformed all its friends. Apple. Apple has massively outperformed all its friends. It's only down 23% year to date, which is amazing compared to everything else, right? And meanwhile, its friends are down 36%, 42%, 46%, 47%, 49%, 55%, and 73% year to date. So Apple's like, I don't want to hang out with my friends anymore. Yeah. And the reason this has happened is twofold, okay? One is they've had record year of earnings. Their fiscal year just ended right now, and it was a record year. Revenues, everything. It's just incredible, right? So that's kept it up. Two, people kind of had a flight to safety, and the view was, at least for the past year, is flight to safety means Apple, right? And things are about to deteriorate there, and they're just starting here. They're just starting, and you're starting to see this play out in Apple stock, okay? So what I'm showing you here is essentially Apple versus S&P 500 this year. It's been almost identical. Literally, it's almost scary how identical it's been. The S&P 500's down 22.4% roughly year to date, and look at Apple, down 23.7%. They're running in line almost perfectly. But check out what I'm about to show you right here, okay? This was in 2018. And what you saw for quite a while is you saw performance of S&P 500 and Apple being pretty in line with each other up until the beginning of November. And starting in the beginning of November all the way through essentially the end of December of 2018, what we saw is Apple drop at a much more substantial clip than the S&P 500, and it wasn't even close. The S&P 500 got nailed, the NASDAQ got nailed, everything got hit, but Apple took the cake and ate it too, I guess we can say that, okay? Apple fell dramatically more, and there was a massive divergence that opened up between Apple stock and the S&P 500, and it's definitely a realistic possibility that this is going to be exactly what plays out this year as well, is this massive underperformance of Apple versus S&P 500, and it completely breaks trend in, maybe the S&P, even goes up or stays flat or maybe goes down, but it's much less than something like Apple does over the next, let's call it few months. There's a lot of things that are deteriorating very rapidly for Apple at this point in time, okay? This just came out recently here. Apple slashes budgets and implements broad hiring freeze, report claims. And this is supposed to be for basically the whole next year. Now, here, think about this logically for a moment, okay? Would Apple be slashing budgets and saying we're going to have a hiring freeze for the next year? Would they do that if they were feeling great about their business? No. Apple would only do that and make a move like that if they were actually very concerned about the state of their business for the next year and the state of their revenues and net income for the next year. They don't make a decision like that unless that happens. That's not, like, businesses don't think like that. Businesses, like, if they think they're going to prosper over the next year, they're hiring, they're building bigger and bigger and bigger. So by Apple making a move like that, that shows you, although, they put up a record fiscal 2022 for the company, and although Tim Cook, could say a lot of good things on conference calls and things like that, you got to look at the actions. And the actions show you there's something brewing there, because you don't make a decision like that unless you're very, very concerned about the state of your business for at least the next year, right? This is a massive, massive deal. I covered this particular part yesterday on the channel. World's largest iPhone assembly plant under new Rona lockdowns in China. And China's going to do whatever they want there. If they want to keep that baby locked down for weeks, they'll do it. If they want to open it and then relock it down, Apple's in no position to dictate anything over there right now. And China's got the biggest U.S. company by the you-know-what right now. And if they want to hurt Apple in a substantial way and keep those plants closed, they can do that. And you might say, well, wouldn't they think practically? I've watched what's played out in Macau. They don't think practically in China. Not right now. They used to. They used to think very practically in China, and you could count on them making responsible decisions. China's changed in the worst way, in a massive way, over the past number of years. And this is something that I think, is definitely a massive risk that not a lot of people are taking even serious right now. Let's hope for the best there, okay? This is something no one is talking about, and I mean no one, okay? And this definitely creates a problem for Apple. So, if you don't know, Apple has spent over $420 billion on share buybacks the past 6 years, and over $550 billion since the buyback program began in their fiscal 2013. Okay, now first thing you could say is, wow, they spend $500-something billion on all these share buybacks. Was that really the best use of capital? Like, what if they just kept that money on their balance sheet, and today they had a war chest of, $500, $600, $700 billion of cash sitting on their balance sheet? Maybe that would have been better use of it. Maybe it would have been better used on research and development. Maybe they could have come out with a lot of great products and services that they're not even involved with. Maybe they could have had some incredible buyouts of different companies. But that's all for debate, right? And I'm not really here to debate that today. That's a debate you guys can have, and we could think about maybe sometime in the future and say, was that really the best use of capital? Is just spending $500 billion plus on share buybacks? Nonetheless, this is very important because they've been spending like insane on these buybacks, right? And how are they doing these buybacks? Well, part of it is they're spending their cash on their balance sheet, the excess proceeds from all the profits they make on these share buybacks. The other part is they've taken on a lot of debt over the years. Back in the Steve Jobs era, he always had the company pretty much, at least once they got out of big financial problems, it always has a company with no debt, right? And obviously Tim Cook and the team changed that over time. And now they have about $100 billion of debt. And this is one of the reasons they've been able to essentially do all those share buybacks, is because of the debt and other instruments they've done out there, right? And as well as spend enormous amounts of cash, right? But here's a problem for this, right? They also are paying out massive amounts of dividends now at this point in time. In 2023, they should pay out, hypothetically, $15 billion plus in dividends. Now, Apple set themselves up in a very weird position here, because if they they have to keep paying these dividends out, which is $15 billion plus of their basically net income. You can say bye-bye to that. That's going toward dividends. And they can't cut that. They can't really do anything there, or it's going to look like Apple's in real problems, because the only time companies ever cut their dividends and take their dividends down to zero, or even cut it in general, is when a company's in major financial troubles. You never see a healthy company say, oh, we're going to cut the dividend. No, it's when they're in major financial troubles and there's big worries about the longevity of their business and what's going on there. So now Apple's basically saying $15 billion of their bottom line is going bye-bye to dividends. They're also have a situation where they've been using tons of cash to do these share buybacks. They have to kind of keep buying back shares, or want to try to, right? Because if they stop buying back shares, then it looks like, oh, what do you believe, your stock's going to go down more? But here's a big, big problem, okay? This is big. The cost of debt is obviously much more now than it was 1 year ago, 2 years ago, 3 years ago. We all know that, right? And so now this creates a dilemma for Apple, where if they want to be in a situation where they want to keep doing these share buybacks, they're going to likely have to take out debt at bad prices potentially. And is that something the management team really wants to do? I don't know about that. Now imagine a scenario where net income goes down for the company in 2023, while they also have to still pay out $15 billion plus in dividends likely. And are they still going to do all these share buybacks, or are they going to likely cut back on that? If I had to guess, they're going to likely cut back on share buybacks in a massive way next year, regardless of what happens with the stock price. Doesn't matter if the stock goes down or up or stays all around. If I had to put money on it, I bet you the share buybacks are going to be down immensely in 2023 versus many of the past years when they were just out there buying shares back. And so what happens to Apple stock without Apple buying up every share in sight like they've been for a number of years now, right? They've been like almost a great supporter of Apple's stock price because they've been buying back so many shares. So now you're in real problems here, and you start to see how this story starts to play out, right? And the other component of this has been, well, you got Apple always out there buying back massive amounts of shares. Well, that could slow in a substantial way in 2023. And you've also had Berkshire Hathaway that's been, over the last number of years, probably 5 years now or so, added a ridiculous amount of Apple shares. But here's the problem. Apple now represents 39% of their stock portfolio. So I'm not so convinced Apple's going to keep adding, Berkshire Hathaway, Warren Buffett's company, I'm not so sure they're going to continue to add Apple aggressively. If I had to guess, I think, this is just my belief, and I've studied Warren Buffett for a long time, I think this is probably the last year they're kind of interested in adding many shares. If the stock really tanked massively, talking like 50% down, something like that, maybe Warren Buffett steps back out there and Berkshire Hathaway picks up some more shares. But at some point in time, Warren Buffett stops kind of buying these stocks, is what I've noticed over time. And he'll add a major position in it. He'll get it built out. It sometimes takes him years and years to do that, which it has obviously with Apple. And then he's good with just holding it for many, many years to go in the future. And he doesn't really sell it, and he just holds it and holds it and holds it. And so I wouldn't be surprised if that's a situation here with Apple, because they're so heavily reliant on Apple, it's almost to an unhealthy state. And now if Apple earnings go down, which is a risk, right? If Apple earnings were to go down in any significant way, it's going to hurt Berkshire's earnings as well. And it's going to hurt the whole outlook for Berkshire's company as well, right? So I would call it a major issue, and it's something that's been working great for Berkshire. As Apple's done tremendous over the last number of years, it's helped Berkshire do even better, and it's helped their earnings per share look better and all these sorts of metrics, right? But it looks like, in my opinion, this is probably the last year that Berkshire is really interested in buying the stock, unless the stock fell massively. I just want to show you guys this. It's crazy. This Stone Co. company, right? They have $128 million in this stock, and it's less than 0.1%. Less than 0.1%, not less than 1%, less than 0.1% of their entire portfolio. That's a flex, man. Imagine having $128 million in a stock, and it's like, yeah, it's such a small position for me. It's not even 0.1% of my portfolio. Jeez. The levels of this game are just amazing to see, okay? So that's not the only issue, okay? I showed you this earlier, but you might have missed something very important here. The other issue of this is now we have competition of money. We have what is called, I call a lack of capital out there in looking for places to go, right? And so if you're in a position where there's a lack of capital out there and it's trying to find the best opportunities, in my opinion, I don't think, and especially from the growth investor side, I don't think they're going to look at Apple. And I think for the hideout money, that already went to Apple this year. So now at this point in time, because these other dogs are down so much, I think if there's money looking to be put to work in 2023, I don't think people are going to be looking at Apple. I think they're going to likely be looking at Google. I think they could be looking at Tesla if that one gets hit harder. I think they could be looking at Amazon down 50% plus. I think they could be looking at Nvidia and AMD, and I think they can be looking at Meta. I think that's where the money's more likely to go, because I think growth investors are kind of turned off of Apple at this point in time, especially if they see net income fall for this company in obviously 2023, which I think is a very, very realistic scenario that could play out here. And so that's a competition of money that I'm thinking investors are going to plug it into these other opportunities, because they're going to say the ROI is just better. They're probably going to say Apple has more downside potential than these stocks that have already gotten hit hard. And they're likely going to say the upside over the next 5 years is much greater in some of these other stocks than it is Apple, just at the end of the day, right? So that's a major issue. Now, when you think about this company, right? This company, the whole company you see set up in front of you is because of two gentlemen. Let's not confuse this. Steve Jobs and Johnny Ive. And neither one of those gentlemen obviously has anything to do with the company. We lost Steve Jobs, unfortunately, 11 years ago, right? All the products that are the big products that Apple's still selling to this day that have hardly changed since he went away, right? They're all Steve Jobs products. iPhone, Mac, iPad, all those products, right? In terms of who was a designer of all these great products over the years that changed Apple's business forever and made it this dominant company, Johnny Ive was. Johnny Ive's the iPhone man, iPad, AirPods, Apple Watch. It's all Johnny Ive. So now we're at this point in time, and there's actually just is funny. There's actually just an article that was put out today, or actually in the last 24 hours by the Wall Street Journal. Johnny Ive, the life after Apple, and it goes into depth on what he's up to nowadays, with his life after Apple and whatnot, right? And these two gentlemen, they're the whole reason Apple's what Apple is nowadays, and why they could generate so much revenue and so much profit, right? And I think Tim Cook's done a good job running the business of Apple that Johnny Ive and Steve Jobs set up. But the problem is, what's going to take Apple into the next decade? And I think that's a real issue when you don't have the two people that set up the last decade. Those guys set this company up for 10 to 15 to 20 years of massive success. But for the next 10 to 20 years of massive success, who's going to be that person at Apple that's the game changer? We've never seen anybody else. And people like Johnny Ive and people like Steve Jobs, those folks just don't come around, okay? And so that's a real issue. And I look at it very similar to Tesla, with obviously Elon Musk and then the head designer of Tesla cars, Franz. They've done amazing work together over the years, and they've set up Tesla for the next decade of success. Now, if Elon Musk and Franz were to go away, eventually, right? Like the company is going to have to prove who else is going to step up to be the next game changer. But those guys are so hard to find that next game changer. And so for Apple, do they have another Johnny Ive there? Do they have another Steve Jobs there? I'm not so sure of that. We haven't seen it. And like I said, those guys just don't pop out like, oh, let's just go hire a Johnny Ive. Let's just go hire Steve Jobs. It doesn't work like that. Those are game changing visionaries that do amazing work that are on a creative level that almost no other human's brains can even work like that and even think about, we're going to do this and we're going to implement it and have the belief and then pull it off. It's amazing stuff. It's almost like catching lightning in a bottle, right? And so that's a huge issue for obviously Apple moving forward. That's not just a short-term issue, that's a long-term issue. And I think eventually investors are going to wake up to this and realize, oh my gosh, the two guys that are the sole reason this company became a multi-trillion-dollar company have nothing to do with this company anymore. Where does it go for the next decade, right? Now, next thing that's an issue here, and this is very, very important, is Apple's weight on the market. So Apple is about 14% of the weight for the NASDAQ 100, for the Qs. So this is something that, if Apple continues to pull down a major weight, it will likely pull down the NASDAQ more. And if you're thinking about how do you get the NASDAQ down 40% plus, right now it's down, 36%, 37% roughly. How do we get it to 40% plus? This baby right here can take it there. If Apple continues to deteriorate over the next 1 to 2 months, it can take the whole NASDAQ down as well in that whole situation. As far as the S&P 500, NASDAQ's Apple's roughly 7% of the weight for the S&P 500. So you're talking about this is a major weight. If it continues to fall, it can pull down the indexes more, right? And that's something that will play out. Now, with that being said, because you might think, well, doesn't that just pull all stocks down? No. It can maybe potentially pull semiconductors down more. It can maybe pull down some other tech stocks down more. But there's going to be divergence in the market. There will be some stocks that actually do really well, while Apple potentially falls even more. And it won't be the first time that's happened either. Just do keep that in mind. And it won't be the last time either. So, we're already starting to see divergence in many different areas. Obviously, you've seen in the Dow versus the NASDAQ. You've seen it in the Russell versus the NASDAQ. And, so that's just something to keep in mind. Now, I will say this. If Apple falls, let's say in any meaningful way, over the next 2 months, I'm going to feel very, very bullish on 2023. The one thing that has scared me, the one thing that I'm like, why has this not happened yet? Apple. That's it. We've gotten everything else has lined up. Tesla, that domino fell. Obviously, all the other big tech fell, right? And it doesn't mean they can't fall more. It's just, it's already happened. So that's huge for the market. But there's this one last pillar, which is called Apple, that I'm like, until that baby falls, I can't feel super confident about like the next year. So if that baby falls and we go down 40-50% on that, I'm going to feel incredibly confident in 2023 kind of moving forward there in terms of how stocks will react and how the market will move in general. But we need to get that baby down more. And I think everything's starting to line up, and I think Wall Street's going to start putting these pieces together, the short-term ones and the long-term ones, and realize, oh, you know what? We should probably think about cashing a little bit here, because there's a lot of folks that have made a lot of profits on that stock over the past number of years. A lot of profits there, man. And I think those folks are going to have to definitely consider, positioning in other stocks for the next couple of years. Okay. Now, this just came out in the past hour or two. Amazon pauses hiring for corporate workforce. This is something we're seeing, across the workforce, right? Meta, what did Meta say on their conference call? This is very important. Meta basically said that they're not going to hire. They're not going to add to their workforce for like the next year to year and a half. Okay. Amazon, hiring freeze. Apple, we just got a report of, that I went into there, hiring freeze, right? So you're seeing this company after company after company after company saying, you know what, we're pulling back. We're pulling back for the next year and a half. That's what we're doing, okay? And so at the end of the day, this will start to obviously hit employment numbers, and which is something the Fed wants to see. And to be honest, the Fed wants to see this. The Fed wants to see Apple, Amazon, Meta, all these massive companies. They want to see Google, McDougal, Microsoft, NVIDIA. They want to see all these companies say, hey, for the next year, we're not hiring. They want to see that. As weird as it sounds, they want to see that. They need to see that to obviously definitely feel like we're in no wage price spiral or anything like that, right? And so that's something that's very important that's playing out there right in front of our eyes right now, right? PayPal and Square both reported after the bell. I looked at both companies' numbers, really good. Those are great stocks for the long term. So that's all I'll say about that. Like if you are interested in anything fintech related, look no further than PayPal and Square for the next 3 years. Those stocks are in a great position. Their valuations are very low. I looked over their numbers. They're very good. And I think those are going to be huge winners over the next 3 years there, okay? Fubo. So obviously Fubo reports in the morning. And I actually bought some shares of Fubo here today. I'm likely going to be buying a lot more shares over the next, I would say, 6 to 12 months here. What I'm looking for from Fubo personally is I want to see them continue to report that, numbers are coming in ahead of schedule. And I want to hear that they're going to make good strides. Obviously, we all know they're going to lose money in 2023, but they need to make good strides in 2023 in terms of their cash flow situation. If they can say, hey, revenue is going to be better than expected, amount of customers at it is ahead of expectations, and cash flows we think are going to be in a healthier place than we had projected and thought about for 2023, that would be massive. And that would be something that, in terms of if you're thinking about that stock going up like 20, 30, 40%, 50%, doubling up in a quick amount of time, that would be huge. So that's what I'm hoping to hear in regards to obviously their conference call and their presentation in general. It looks like demand's incredible for them. It looks like it's going to continue to be incredible. They got amazing retention, and now they just obviously just got to put up the numbers and let us know that things are on the right track in terms of everything that I think is going on there. So really excited about those earnings of there. Hope you guys enjoyed this video as always. If you haven't got to check out my new reaction channel, Jeremy Lefebvre Makes Money, definitely check that out, including the video I put out today. That was a beast video. Kathy Wood, what she just said about Tesla stock, what she said about the economy, what she said about her stocks in general, the stock market in general, and a big prediction she made for Bitcoin. So definitely check out that. I'm enjoying that channel, and thank you for everybody that's subscribed, not just to this channel, but also that channel as well, and you're enjoying the reaction channel. Much love as always, and have a great day.